So then consider the situation within our economy, that we appear to be in the middle of a housing recovery and stock market boom, during a period when we are in the middle of a non-technical depression. But how can this be? There actually was a genuine numerical economic recovery which began in 2009, and which lasted through 2011, even if this was the result of a combination of low interest rates and government stimulus through trillions of money driven in the economy. And this boost is reflected in almost every chart one might wish to regard, because the climb out of the deep economic decline which began in 2008 was especially steep. But during the summer of 2011 the arising economic sluggishness in the economy was then being attributed by the government to a short-term slowdown which was the consequence of the recent Japanese earthquake. And while the perspective then was that this must then only be a transitory phenomenon upsetting the recovery, it was probably also latched onto by those in the halls of government, who not only were hopeful that the economy was already in a sustained recovery by this point, but likewise that the statistical trend lines would continue to move upwards right through the campaigning for the 2012 presidential election, which was then just about to get underway. So what a shock and disappointment it must have been for the president and his staff to find that in August of 2011, as the debate concerning raising the government debt ceiling was stalling, that the stock market suddenly took a nosedive, and within a few days had declined about 17%. Clearly, they would have thought that this decline was tied to what was then most upon their minds, and how it was attributed in the media, which was that it was brought about by the debt ceiling debate impasse, and likewise the coincident S&P United States credit downgrade. And while it might be reasonable to assume that the current headlines are what are driving markets, and that these two factors are yet broadly used to explain the decline of the markets in August of 2011, they actually had nothing to do with the rapid decline in equity markets. In fact, generally speaking, all headlines do is to create market noise. They cannot drive the markets. Only economic fundamentals can truly drive market direction. The details of this were laid out in my book Rally, A President's Obsession, but suffice it here to show that the sudden decline in the market had everything to do with the sudden reversal of the economy, both the United States and global economy, from one of expansion to one of contraction, and this is reflected in the emergence of the crisis in Europe, and a sudden sharp decline in economic indicators here at home, in the middle of 2011. And the true cause of this decline in the stock market becomes obvious once the stock market is overlaid with something which provides an accurate measure of economic activity, which is the price of aluminum. Typically it has been known that the stock market follows the general direction of copper prices, which is still largely true, but the correspondence between aluminum price and the Dow Jones Industrial Average, DJIA, is far more evident, and is shown below, at least up to a certain point. And what is supremely evident from this graph is that the decline in the DJIA had to do with the correction after stock markets had continued upwards even while the economy had already shifted downwards. This effect is due to simple psychology, which tends to drive a market trend beyond its natural limit. Thus the economy began to get worse, but the stock markets continued for a month or so on its upward path, before August, when it finally fell back in line with the economy, as revealed by the price of aluminum. Thus this was natural correction, and had nothing to do with whatever politicians were debating or doing in Washington, D.C. However, the more important conclusion to be drawn from the same chart is that shortly after the market correction, something strange happens just a couple months later. In that suddenly markets begin to diverge from the economy. Starting on October 4, 2011, markets suddenly begin their own path unstoppably upwards, while the economic indicators just keep slipping. So why did the markets suddenly detach themselves from economic reality at this time? One could argue, as the monotonous press offers, that this increase has been due to the actions of the Federal Reserve's QE, quantitative easing, and most people think the same because they hear this said by experts and analysts and economists on the media. But this conclusion makes no sense at all. And this discrepancy between the economic reality and stock markets is precisely what is meant by the Big Obama bubble, and this is the situation in the markets right now. And while this general market movement has been variously explained or justified by analysts, very few have apparently called it into question, on the view that it is the result of far more involvement by the federal government into financial markets than they have ever taken before. In fact, that it is not only the result of direct intervention into markets, but for the express purpose of driving them up and preventing them from crashing. Here is another graph revealing the very same bubble, but likewise how this current bubble is of an entirely different nature, and the previous two from the years 2000 and 2008, which can be perceived in this graph of the S&P 500 index divided by CPI. This reveals the adjusted S&P 500 showing the market blowing past the upper trend line, where these trend lines indicate the upper and lower limits of the market during its general decline since the year 2000. These lines indicate that the market rise, which began in 2009, reached its natural peak in mid-2011, and since the prediction would follow the declining line at the right-hand side of the graph from 6 to 2, the S&P 500 index has gone precisely opposite, however, from 6 up to 8, while aluminum price, as an indicator of actual economic activity, has dropped from 6 to 4, and is nearly in line with the S&P prediction line. What this indicates is that aluminum prices are giving a far more reliable measure of where stock markets ought to be if there were no bubble. As equity markets and base metal prices have become virtual mirror images of each other, what precisely changed on October 4th that caused stock markets to suddenly detach themselves from the economy? Certainly the Federal Reserve introduced Operation Twist, OT, which continued the trend begun in 2008 to reduce interest rates beyond what could be done with the funds rate, because this had already been reduced to zero and could not be pushed lower. At the time that markets were beginning this unexpected and unstoppable climb, the Federal Reserve was selling its own shorter-term bonds and using this money to buy longer-term bonds to drive down long-term interest rates. However, this method of reducing interest rates not only can only reduce one interest rate at the cost of driving up the other, doing such a thing can only at best promote a general increase in money supply. Even if interest rates are declining, this only theoretically also pushes more money into stock markets. However, reducing interest rates cannot control the market. In fact, the efforts of the Federal Reserve had hardly any impact in lowering interest rates at all due to these efforts. Here we can see that the largest declines in interest rates actually arose at the times when stock markets were plunging. And while this does indicate that interest rates actually rose during QE1 and QE2, they could have been held below where they would have been if there had been no QE. But if considering this provides any indication, then interest rates held pretty flat for about a year between the fall of 2011 and 2012, and thus it was not declining interest rates which suddenly caused the stock market to inexplicably surge and grow from October 2011. And more than this, the impact of the Fed's QE showed no increased investment in stock markets above the price of aluminum. In other words, if QE were actually driving interest rates down and thus driving money into the stock market, this certainly is not revealed in the data, which shows the stock markets were otherwise tracking the economy. Thus the only evident benefit QE could have had was any impact it might have had on the United States economy, rather than because money was being driven into the stock market due to lowering interest rates. And, in any case, interest rates during QE1 and QE2 were actually on the rise. So what is all this talk about the Federal Reserve being responsible for holding down interest rates, and thereby encouraging money to flow into stocks? What is the basis for this thinking at all apart from mere theory? So if the sudden reversal and rises in the United States and even EU stock markets were not due to a growing economy and were not due to the actions of the Federal Reserve, precisely why have markets not only risen but were eventually destined to rise over 50% from their 2011 lows over the next 2 years? Many television analysts have opted for explaining this according to what they know, despite the evidence to the contrary, and still attribute this to the actions of the Federal Reserve and its then chairman Ben Bernanke. However, this is simply not the case, any more than the debt ceiling debate and credit downgrade caused the stock market's decline in 2011, as the president and most people still believe. So putting aside the question of precisely why analysts and the media appear to have their heads up their asses, what has produced this incredible and ongoing unstoppable stock market surge? The answer is simply that the United States Federal Executive determined that we could just not afford a stock market crash to derail the recovery, and that the only way they could assure that the stock market would not crash was to simply take it over themselves. The precise details of how and why this occurred I will lay out in a forthcoming chapter, so what I will provide now is merely a brief summary of the evidence that this government takeover of equity markets has actually taken place and continues to this day. One of the simplest proofs that the government is now currently engaged in a complete control of equity markets is simply that since evidence of this first became apparent in the last hour of trading on October 4, 2011, that the S&P has climbed from 1100 to 1855 as of today, a steady gain of nearly 70% after the market had already climbed about 60% in the prior 2.5 years, from about 680 to 1100. However, this former increase was due to economic improvement, while this latter improvement is not, although the released GDP figures and earnings might well suggest that such gains are entirely warranted. But even so, a gain of 70% when the economy is only growing according to official reports at about 2% is entirely inexplicable. And not only did this reversal lead to an unstoppable bull market, which has been going on now for over 2 years, on top of this, it began just before the S&P 500 was about to sink into bear market territory, which would have occurred should it close below 1096. As it was, just in the final hour of trading on October 4, the market suddenly surged upwards, rising up nearly 5% so that it might close above the prior day's closing of 1099, thus narrowly avoiding the bear market headline. And what was the supposed cause of this intraday turnaround? Apparently, because the EU had announced that they were going to recapitalize their banks. Suddenly it seemed in the media as though this pledge alone would be enough to solve the entire EU crisis, or at least this is how it appeared it must be taken given that all the downward stock market trends suddenly reversed, and in less than a month United States markets were up 17% from that yearly low. But this was only the beginning, and clearly by being aware that the markets were being controlled by the government would also explain precisely why the market would be able to just continue on its merry path upwards, despite anything which might otherwise hinder it. But it also made me wonder precisely who knew, and more to the point, who was benefiting from insider information about this covert government operation. And I still continue to wonder at this. So this is the bubble, the Big Bama bubble we were speaking of, and the precise nature of how this is likely to have formed will be forthcoming. However, back then when this began I was not looking at aluminum prices, but rather I was tracking some very peculiar movements in the stock markets themselves. And this was several peculiar and inexplicable movements in the intraday charts, day after day, which showed markets being stoked with high point increases before the opening bell, predictable intraday movements to the upside, and downward trends suddenly and uncannily reversing, and leading the trend up above its prior day's break-even, where it then held steady until closing. This is not normal for equity markets, and it is these peculiar indications which made it clear that something funny was going on. And only those who merely accept the market for what it does were willing to accept without much question this inexplicable resilience in markets, and strangely they certainly haven't attributed it to direct government control of markets. While, at the same time, every day another explanation came along as to why markets might be up yet again today, despite the release of bad or disagreeable data, while the pervading explanation on CNBC during the early months of 2012 was that this was simply hopium, which was their word for anticipation of further QE by the Federal Reserve, which much of the gains from 2009 and 2011 had been attributed to. But since the crash in 2011 had likewise occurred at a time when investors and traders were anticipating forthcoming QE given the softening economic data, neither QE nor the anticipation of QE could explain why the market would have continued a steady rise from December 2011 through to April of 2012. Yet despite this, analysts and observers did not second-guess the market itself, because it appeared to be intent on rising, and, yes, rising. And even now the market has continued just going up and up and up, and no doubt will right through this year's midterm elections. Because the president yet believes that the only thing which is upsetting the recovery is the fear and uncertainty being created by Washington gridlock, so that he believes that if the Democrats take the House back, that he can end this gridlock, and even get further stimulus passed, and then he thinks he can overcome the economic decline which we are in the middle of now, which he is working so hard to disguise. There is nothing that succeeds like success, and if one measures success by their ability to drive the stock market up, then clearly they have achieved their goal, even if they are the ones doing it.